Good evening, everybody. Welcome to Finet SG with Xian Wei. And we are on episode 17 already, my friends. And I shall get started by sharing the screen. Okay, so welcome. We are moving into part 2 of value investing. An opinion piece, which is from last episode already, episode 16. Whether value investing is dead or has it evolved? And today we shall carry on with part 2. Before that, I want to give a short introduction. I'm Xian Wei and I'm in the business of investment risk management. So this is a professional practice that I have, and I had a little history. From 25 years old, I had 25,000 worth of assets. And with good relationship with Unicorn, the partnership with Unicorn, I've actually amassed to $200,000 worth of assets in 5 years. And it's really true, the partnership with Unicorn that helped me to witness my own success in wealth, but there will be more to come. Because of 2 trigger events in my life, in my family, that really motivated me to expound beyond just myself and reaching out and providing more for my parents, and also reaching out to friends like you, loved ones and friends like you. The reason why this series, this educational series is born is really because of you. I do wish that you'll be inspired by this financial wisdom that has gone on for 16 episodes, and now we are going on to the 17th. That you will ponder upon what would be helpful for you at this point in time in answering this question. How would you like to carry on from your current financial position? How would you like to outshine your current financial position? That's really the question there. Okay, so let me carry on and understand and move on to this question, this topic about whether value investing is dead or has it evolved. So last week I was sharing, I ended off here by Mr. Warren Buffett. Growth and value investing are joined at the hip. A moment on the lips, forever on the hips. But this one is a piece that I really want to share with you from Mr. Warren Buffett, what it means. Because the financial industry has actually separated them. But actually, in my own view, growth and value investing are actually joined. What do I mean by that? Last week, I came across this question with you, and we were going through this exercise. Which company would you pay $1 million for? Company A, Company B, or Company C? And we have understood from there that in terms of its value, you can see the profit of $50,000 in Company C, but it will always grow in terms of 20% year on year for the next 15 years. Then look at the result of it. If you just focus on the growth of 50,000 every year and on a 20% growth on that 50,000, your valuation is actually at $3.6 million. So if your $1 million become $3.6 million, is very worth it. So that is also the value that the company is in terms of its assets. So that's why I mentioned growth and value, they are actually joined at the hip. And take note of it, because today I'm talking a lot more on the part growth and how value investing is considered dead only in a certain perspective. Okay? So because of that, let me just give you an example in terms of looking at growth and valuation. So let's say university students, they get into university and they get first class honors. Do you think it's because they did very well in the first exam or in the last exam? No, right? It's because they have done consistently well for them to be able to get first class honors, right? So it's the same thing here in terms of growth. If you're consistently on the growth of 20%, for instance, then the value that you get at the end of the day is also of a very high quality. So that's what I mean by Mr. Warren Buffett's growth and value investing are joined at the hip. Okay? Then let me continue this. So the value investing, is it dead or has it evolved? So really need to look into the company's life. Today's earnings and going forward, how has the growth actually been like? So in the past, we always look at the valuation only and past performances and its present financial position. Then we try to value it, right? And from there, we try to get it at a discount. So coming into this, they are actually moving, the evolution for value investing can help us to understand why some people has mentioned that value investing is dead. Because just like technology, we have evolved. So last time in 1.0 of value investing, Mr. Benjamin Graham, who is the teacher of Warren Buffett, he coined this value investing term because he came from a period of Great Depression where he is very afraid of losing money already. So his framework is literally looking at a very defined line. If he sees the net asset value of this company at $1 million, and if he's willing to go on a discount, so he will have a margin of safety, let's say at 60%. So at 600K worth of that value, he will invest in it. So always buying things on a discount to the net current asset value. So that is the first 1.0 part of value investing. And then when Mr. Warren Buffett learned from him, also started on value investing following the framework at first, but it evolved into 2.0 because of Charlie Munger. Because Charlie Munger has helped him to understand that, hey, I don't think that this is what it means to be value investing at this point in time. It's not just valuing or having a security analysis on the company itself, but we should also take note of its growth, of its potential for growth to help create this eighth wonder of the world by Mr. Einstein, that is the power of compounding. So if you focus or pay attention to value growth mode with companies with competent managers, that gives much better potential for growth in companies like that, then that is the new framework on top of the fact that they should get it at a discount. So that evolved into 2.0. So in terms of that, then that's for a long period of time, Mr. Warren Buffett in this framework for many years, many decades, and he has served him very well because we can see that he's a very wealthy man, and the companies he owns are also very valuable and of high quality. So it served him well for many years. But how about now? Is it going to serve us well with this new environment that we're in? So that's why we have a need for this 3.0 in our value investing. Because it's on the fact that, number one, yes, we got to look at things that we can get at a discount, and also look at its potential growth, that is 2.0. But nowadays, those that has great potential for growth doesn't seem to be going on a discount. So if that's the case, will we miss the boat by waiting for discounts? Because the value can just get higher and higher, right? Then what do we do about it? We're going to make a slight tweak in order to reach to 3.0 in value investing. Okay? So to give you a little bit more understanding of what this 1.0 evolved to 3.0 is like, the 1.0 came from this book, The Intelligent Investor. So if you're interested to really go into detail, you can have a read at this, or just ping me to share with me your thoughts on what you have read. So value investing 1.0 is to avoid loss, margin of safety, net, to really understand what is it that you are able to value as a company, and then what they can pay for at a cheaper price. 2.0 is, as per mentioned over here, is the fact that it has high return on capital and making sure that it's non-cyclical. Then 3.0 is what we're going to talk about a little bit more today in a more intense. So it's more on the future of the businesses, the life and the story of this company, how we're going to view its future growth, and build on the confidence in order to select these quality companies for this exponential growth that we're looking for. at a reasonable price, because we are all educated here and it may never go down on a discount. Okay? So if I share with you maybe just a story just to help you understand and encapsulate this sharing, it's probably a newspaper company that will be very helpful. So in the past, there's this newspaper company or agency that is in this very sleepy village, that is operating its business in a very sleepy village. So it will continue. It's been doing very well in its business. It's one of the only few newspaper agencies in this village, and it's selling physical newspapers very often. And because it's one of the main competitors or the main agencies, they are doing very well. So consistently showing very good business in selling newspapers, the physical ones. So by looking at just its past performance and its current financial standing, they can invest in such companies because it will just continue to be stable and doing well, or perhaps grow slowly as the population grows in this sleepy village. And that is probably understanding value investing in the earlier times. But how about now? What is the era now that we're in? If this newspaper agency is moving into a fast-paced city, and actually there is not many competitors selling physical newspapers, do you think it will make a lot of money or a lot of business in selling physical newspapers? So probably not. Because what is a fast-paced city doing? They're actually getting their news from social media, at least from online newspapers. Okay, so the competitors are actually not the physical newspaper agencies, but they're actually on the online newspaper agencies, or even just social media alone. So that makes the future of this newspaper agency very weak. And it's not just looking at historical records anymore and its present financial standings that will be very supportive in you as an investor choosing really the company that can serve you well in terms of wealth creation and accumulation. Ultimately, we are here to grow our wealth. So that's the meaning of value investing 3.0. Okay? We are in the era of disruption. So either be disrupted or you be the disruptor. So this newspaper story is really a good story to share how it is being disrupted. In terms of its business model, in the past it can be very, very strong. But once it's disrupted by, let's say, technology, then, or the future of business is just different, then that's where you really suffer. And if you yourself as an investor are holding into businesses or company stocks like this, consider it deeply, whether it's really going to give you growth or not. I was just sharing with my friends, my partner, about looking at Singtel shares. Okay, maybe not so much on Singtel itself, but the shares that are on cyclical growth. And many episodes I've been talking about cyclical growth. Many episodes ago, I wasn't always talking about cyclical growth. But on that, it follows the economy. So if the economy is good, the market will, the company will do well. But if the economy is bad, the company will also not do very well. And unfortunately, some of the companies that I myself have been holding on to are facing such risks. Then I ask myself, with the amount that I'm holding still, whatever value it may be, let's say it's worth $10,000, can I put it into a better position for it to really grow from now on? Because I ask myself, if I look at the cyclical companies that I'm in, that I have holding on to my own shares, and then expecting it to grow at 160%, for instance, from now till later, to a short period of time. Is it possible or not? These are the questions I really ask myself, because in the era of disruption, there are more potential companies that has bigger growth that can help me to regain the value that I have. Because the $10,000 value that I have can be improved rather than looking at it as a loss. So that is the story of era of disruption. And how we can further understand what this new revolution is about, technological revolution that is really disrupting our era, we can take a look historically. How have we revolutionized since very long ago, since 1650, in the agricultural revolution to all the way to technological revolution. So you can see very quickly over here on the left side, the agricultural revolution very long ago, 1600 to 1800. It was just having more machines to quicken the pace of agricultural move for this population increase or boom at that period of time. So they were building more and more machines for agricultural growth revolution. And then soon it was Industrial Revolution in 1760 all the way to 1840, where you can see a lot of manufacturing companies start to build their own industries and industrialize many things that came into our lives after that. And then after that, 1896, close to 1900, that's when Dow Jones started, where the stock market started to really help us come into understanding of investments. And ever since then, there hasn't been much revolution until year 2000. Can you imagine that? That's really a long time ago. Yeah. So what has this year 2000 been? That was when I was just 12 years old. And it was the dot-com bubble burst that caused everybody to be in shock and went into crisis. But many people were saying that it's just a fad, right? That this technological dot-com burst is just gonna wash away. But it didn't. There were big companies like Amazon that was born then, and Google, and many of these big companies now, this global influence, were just seedlings during the year 2000. So this technological revolution has been started since year 2000. Why am I saying that? Because this is the part where we really talk about not just things have changed quickly since year 2000. It's because we haven't actually faced any major revolution for us to get the hang of this new technological revolution. And what is the consequence of it? So talking about this Jeffrey Gundlach, who is the founder of Double Line Capital, who's a really good investor, fund manager of bonds, holding $150 billion of assets under advisory. So he was saying things like this. This news is very important because he mentioned about six problems with the rally. So in the last 10 years, before our pandemic crisis came, actually the Super 6, which came from the dot-com crash, well, at least some of them really came directly from the dot-com crash, except Facebook, which consists of Facebook, Amazon, Apple, Google. So these 6 companies, okay, have been the ones that really made the most profits that support the entire United Stocks market. It may be a bit exaggerating. Of course, there are other companies that are also profiting. But you can imagine, what does this mean? That means the other companies haven't been growing or even on a negative growth. So just to take a pause here and understand, yes, the pandemic has actually been very serious and it's definitely the cause of a lot of our crisis management at this point in time. But maybe you can also take a look at what happened before that. Before that, there was already a lot of problems. It's just that the crisis, the pandemic crisis, is the trigger of our not so good economy. So because of this technological revolution, Microsoft growth has accelerated as pandemic boosts the cloud business. So definitely there are a few companies that we can be more focused on in terms of really creating our wealth and growing our wealth. And we can only focus not just the six companies, but we have to put in more effort to figure out where to find all these structurally strong and growing companies that we can hang on to. Because already from the last 5 years or the last 10 years, there hasn't been a lot of companies that are growing. So if you have seen a lot of companies that are at a bargain now, at a discount now, just take a deeper understanding or go through my previous episodes or even speak to me and help yourself to understand if they are a bargain, is it because of a fundamental problem, or they are really at a bargain, ready to buy at discount for future growth. Very, very important note here, because not many companies are good quality. Okay, so the last part is probably to share with you, but whether you want to stay as an investor or growing, or someone who's just focused on wealth growth, stay on the side of being disrupted, or would you like to be the possible disruptor instead? So very obvious from this pandemic, we can see retail malls may be facing a permanent change. If e-commerce is growing from this pandemic issue, so retail malls may seem a little bit redundant, right? Office spaces, we can also start to see that so many people can work from home and they've gotten used to it and they become more and more productive. So why not? We can all choose to work from home from time to time. So post-pandemic can still have this kind of scenarios. Banking and insurance is quite obvious because it's coming into the part where the interest rates are dropping, are lowering because of what the US federal government is doing, that they may not be able to make a lot of business out of it because they are always their profit drivers is on interest rates. Oil and gas. I was just speaking to someone from oil and gas, a client, that he shared with me, the situation now, people moving on to the new energy, plus the fact that it's pandemic, a lot of contracts are also on hold, is really stressing out oil and gas. Traditional media, don't need to mention. I already gave a story on that. So if not, or we look at the possibility of investing on the disruptors. So this list is not exhaustive. And once again, just a disclaimer, it's really not intended for investment advice. Please seek professional advice, or at least speak to me before you jump on the gun or say anything. Okay, just this last bit. Imagine if you had that $100,000 and you actually invested, and this is historical value on these 4 companies. So I would just name LabTech as the company. If you had $100,000 and you invested since 2014, your growth is at 1,500%. That means you could have gotten $1.5 billion. So if you were to invest in technology, it will be 5 times. That could fetch you $500,000. And if you will go to the bank or the airline, as you can see the fall, so you could be left with $37,000, for instance, or it could be a lot less than that. So these are the 4 types of company I've been sharing for the last 16 episodes. And if you want to find out more how it is or what type of companies they are, please let me know or PM me. Then I can share a little bit more with you. But this is what it means. It's very, very different when you select the right structural growth companies. Even if you were to select just technology alone, it will change. It will change your entire life, actually. Okay, just 3 things that I want to highlight to you. Most importantly, get started. Financial wisdom on itself, if you have just gotten it as knowledge, it's just potential power. The real power is when you have action on it and that you are able to apply what was being taught today. So, number 1, start. Act on it. Do it on your own in terms of your analysis, or maybe you can come to me as a number 2, where you can seek professional partnership with me. Or number 3, if you have already started and you realize that you may not be doing as well as you like it to be, you can also seek for my advice, or just come to me and see if there's any chance for you to do portfolio repair. Okay, I have a good friend who gave me a feedback on him wanting to know a little bit more on the round table of 8. which I wanted to share after I complete my part 2 of this opinion piece of whether value investing is dead. So next week, I will definitely give a chance to help you understand what it is, what does it mean to really go through at least the first 3 of it. Cash flow and budgeting, cash flow management and budgeting, then economic life value risk management planning, and wealth accumulation. Because these are the 3 things that are very, very strong fundamentals for your financial success. Okay, if not, just to help you understand, I can serve you in this manner, these 2 ways: advisory on cash flow management and budgeting, and definitely advisory on optimizing your resources to increase your overall returns on your assets. If not, I will see you next week. It's already gonna be September, next week Tuesday at 8 p.m. It's since April, since circuit breaker when I started this webinar, and I've been enjoying myself more and more. So looking forward to see you next week as we move on to this opinion piece and we're talking about a sharing from a close fund management partner that we really work very closely and very happy in partnership with. And I will share more next week. Okay, if there's any questions you would like to share with me, of course PM me directly. If you are too shy for it, maybe you can also go on the QR code to just let me know some of your questions, your concerns. But feel free to really reach out to me. If not, I will see you next week, my friends. And have a good night and enjoy the rest of the week.